Hey friends, welcome to today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. Semcorp Industries has made a significant move in the renewable energy space that deserves our attention. The company's wholly owned subsidiary, Semcorp Solar Singapore, has just signed a 25-year renewable energy purchase agreement with Meta Platforms' subsidiary, Malcoha. This is a big deal for both companies. Under this agreement, Sembcorp will build, own, and operate a floating solar photovoltaic system on Kranji Reservoir. We're talking about a massive 150 megawatt peak system here, which will directly support Meta's operations in Singapore. Construction of this floating solar farm is expected to begin in the first half of 2027, so this is a long-term project with steady revenue potential. For those unfamiliar with Semcorp Industries, they're a leading energy and urban solutions provider with a strong focus on the green energy transition. They've been pivoting towards sustainable solutions over the past few years, and this deal reinforces that strategic direction. Despite this positive news, Semcorp's shares closed 0.5% or $0.03 lower at $6.37 on Thursday. This slight dip doesn't seem to reflect the long-term potential of this agreement. The current share price still represents a strong position, especially considering Semcorp's growing renewable energy portfolio. From a technical standpoint, Semcorp has been trading in a relatively stable range recently. The company's PE ratio remains competitive within the utilities sector, and their continued expansion into renewable energy projects positions them well for future growth as Singapore and the broader region push toward greener energy solutions. The floating solar farm at Kranji Reservoir will join Sembcorp's growing portfolio of renewable assets. Singapore has limited land for solar installations, so floating solar technology represents an innovative solution to maximize renewable energy generation. This project aligns perfectly with Singapore's Green Plan 2030, which aims to quadruple solar energy deployment by 2025. Chinese electric vehicle maker Nio has announced plans to raise HK4 billion, approximately $688 million, through a share placement. This capital raising effort is specifically targeted at funding research and development of smart electric vehicles, showing Nio's commitment to innovation in this competitive space. The company plans to offer about 136.8 million shares at H20 46 cents each. That's a nearly 10% discount to the stock's latest closing price of $32.55 on the Hong Kong bourse. Since this announcement, Nio's shares have taken a hit on the New York Stock Exchange. In Singapore, the counter closed 3.2% or US $114 lower at US $4.29 on Thursday. For those who might not be familiar with Nio, they are one of the leading premium electric vehicle manufacturers in China, often dubbed the Tesla of China. Founded in 2014, Nio has built a reputation for high-performance electric vehicles with cutting-edge technology and innovative features like battery swap stations. This capital raising comes at a challenging time for Nio and the broader EV market. The company has been facing intense competition in China from both domestic rivals like BYD and Li Auto, as well as international players like Tesla. The global EV market has also seen some cooling off after years of explosive growth, with concerns about economic slowdowns and reduced subsidies in key markets. From a technical analysis perspective, Nio's stock has been on a downward trend over the past year, currently trading well below its 52-week high. The trading volume has been elevated following this announcement, indicating significant investor interest, though much of it appears to be selling pressure. The discount offered on the new shares suggests Nio is eager to secure this funding, possibly indicating some urgency in their R&D roadmap. For investors, this raises questions about the company's cash burn rate and path to profitability, which has been a concern for many EV startups. There's a leadership change happening at Keppel Infrastructure Trust that investors should be aware of. Mark Yo, who serves as the non-executive and independent director of Keppel Infrastructure Fund Management, the trustee manager of KITE, will be retiring from his directorship role after the upcoming annual general meeting on April 15th. According to Friday's bourse filing, the 62-year-old Yo will also step down from his roles as the chairman of the Audit and Risk Committee and as a member of the Nomination and Remuneration Committee. Adrian Chan, 60, will take over as the chairman of the Audit and Risk Committee. For those not familiar with Keppel Infrastructure Trust, it's one of Singapore's largest infrastructure business trusts with a diversified portfolio of infrastructure assets. These include energy assets, distribution and network assets, and waste and water assets across Singapore, Australia, and other markets. The trust's units closed unchanged on Thursday at $42. KID has been trading in a relatively narrow range over the past few months, offering investors a steady dividend yield that's attractive in the current environment. Leadership transitions like this are normal for trusts and companies, but they're always worth monitoring. Adrian Chan, who will be taking over the Audit and Risk Committee chairmanship, brings significant experience to the role. Investors should watch for any subtle shifts in strategy or focus that might emerge following this transition. KID's portfolio remains well diversified across different infrastructure segments, which provides some stability in uncertain economic times. The trust continues to focus on delivering long-term, sustainable distributions to unit holders through its portfolio of essential infrastructure assets. From a technical standpoint, KID has been trading below its net asset value, which some value investors might find attractive. The trust's yield remains competitive within the infrastructure trust segment, making it a consideration for income-focused investors. Singapore Post has just completed a major divestment that significantly strengthens its financial position. SingPost has sold its Australian logistics business, Freight Management Holdings, for $1 billion, approximately $845 million, to Australia-headquartered private equity investment firm Pacific Equity Partners. This divestment has generated gross proceeds of about $781.5 million, which is actually higher than the previously expected $775.9 million. The estimated gain from this transaction is a substantial $289.5 million. Following this news, shares of SingPost closed 1.7% or *01 higher at $585 on Thursday. For those who might not be familiar with Singapore Post, it's Singapore's national postal service provider that has been transforming itself in recent years to adapt to the decline in traditional mail volumes. The company has been expanding into logistics and e-commerce fulfillment services across the Asia-Pacific region. This divestment represents a significant strategic move for SingPost. The company had been expanding its international logistics footprint, but this sale suggests a potential refocusing of its strategy. The substantial proceeds from this divestment provide SingPost with significant financial flexibility, potentially allowing it to reduce debt, return capital to shareholders, or reinvest in other growth areas. The Australian logistics market has become increasingly competitive, with major players like Australia Post, Toll, and DHL all vying for market share. By divesting this business, SingPost may be choosing to focus its resources on markets where it has stronger competitive advantages. From a technical analysis perspective, SingPost's share price has been relatively range-bound over the past year, but this positive news could provide some upward momentum. The trading volume was elevated following the announcement, indicating increased investor interest. The gain of $289.5 million from this divestment is substantial relative to SingPost's market capitalization, which stands at around $1.3 billion. This windfall could potentially lead to special dividends or share buybacks, though the company has not yet announced specific plans for the proceeds. As we move forward, keep an eye on how these companies adapt to the evolving economic